Good afternoon. Thank you for joining us today. I'm Bill Schmaltzel, a partner in Mayor Brown's Chicago office. I'm a member of our tax controversy group where I represent clients in all stages of tax litigation, including audits, administrative proceedings, the United States Tax Court, Federal District Court, and Courts of Appeals. Joining me today as co-presenter is my colleague, Mike Coppa, who is also a member of our tax controversy team in our Chicago office. Today we'll cover sustaining your research credit cost allocations, making the most of what you have. As we go along, we hope that you will ask questions. If you would like to ask a question during the presentation, please use the Q&A panel on the right side of your screen. We'll make every effort to answer them towards the end of the webinar. If we are unable to answer your question during the presentation, we will follow up with you directly once the webinar has ended. Regarding CLE credits, we will be providing an alphanumeric code at some point during the presentation. In order to receive CLE credits, participants must record this code on the virtual sign-in sheet that was mailed to you with your log-on instructions for today's program. With that, let's get started. As I expect most of you know, eligibility for the research credit requires satisfying 4 requirements. The research expenditures need to be research and development costs in the experimental or laboratory sense, the Section 174 test. Then the research must be undertaken to discover technological information as distinguished from consumer preferences or some type of social science information. Third, the cost must be intended to be useful in the development of a new or improved business component of the taxpayer. And lastly, substantially all of the research and experimental activities must constitute elements of a process of experimentation. Now, actually obtaining the credit requires really a 2-part process. First, you have to establish that the activity that you're talking about meets the 4 tests that I just described. However, there is also a second aspect to obtaining the credit, which is being able to allocate expenses to those particular qualifying activities. Previously, we did a seminar, Re-engineering Your Document Collection Process, where we focused on how to use documents which help you establish that you've met the first 4-part test. In this presentation, if you are interested and didn't previously see it, is available on our website as well, and you can pull that up. Today, however, we're going to focus on the challenges of supporting the allocation of costs to qualified research activities, since this is a significant challenge for many taxpayers and has been a major issue in some litigated cases. The problem often is that taxpayers do not have an existing system to track costs of specific research activities. To the extent your financial accounting system identifies research expenses, that system is often inadequate for identifying the requirements for Section 41. Financial accounting standards are both over and under inclusive. Expenses that are not eligible for financial accounting purposes, such as testing activities, are nonetheless eligible for Section 41. Further, there may be cost centers where it's perfectly appropriate to claim them for financial accounting purposes, but you need to exclude parts of that cost center for the tax purposes. Therefore, we've seen taxpayers have to develop a variety of methods to estimate and allocate the research expenses for the particular purpose of obtaining the research credit. Over the years, we've seen a number of common approaches, which we're going to be talking about today, and offering suggestions on how you might be able to take the system that is used within your company and perhaps improve it in certain ways. We'll focus primarily on the question of how you allocate wages to qualifying activities, but we will also discuss how you can treat supplies and contract research. Mike, could you give us some background on what standards exist for allocating costs?
Certainly. So first, I want to talk about some of the legislative history of Section 41 as well as the case law in this area. And unfortunately, neither the legislative history nor the regulations under Section 41 or any of the case law really provide any clarity regarding how taxpayers should allocate costs to qualifying research. So this leaves taxpayers with a fair amount of flexibility in how they're going to create a system for allocating costs for purposes of calculating their research credit. And fortunately, while the case law does not necessarily outline specific requirements for how costs are allocated, courts that have addressed this issue have stated that taxpayers are not necessarily required to have perfect records to support their allocation of costs for purposes of computing the credit. Despite this flexibility, however, taxpayers do still need to establish, at a minimum, that the company is in fact performing qualified research. If the taxpayer doesn't have perfect records to support every expenditure claimed, it nonetheless still establishes a reasonable basis that they are indeed incurring substantial expenses before an estimate of the amount of expenses can be made. We note here the Second Circuit's opinion in the case of Cohan v. Commissioner. This case is frequently cited for the principle that is often referred to as the Cohan Rule. And the Cohan Rule essentially says that, if a taxpayer is trying to obtain a tax benefit, such as entertainment, travel and entertainment expenses, and as well as Section 41 research credits, if the taxpayer doesn't have perfect records to substantiate that expenditure, as long as they get establish a reasonable basis that they are incurring those expenses, the court may make an estimate based on the available evidence, bearing heavily if it chooses upon the taxpayer. And oftentimes in these situations, if the records aren't perfect, the taxpayer may take, a haircut off the top to reflect their imperfect record keeping. But, the point of this rule is that, while you may not have the perfect system for recording costs, as long as you can establish that your research and development department is indeed incurring qualified expenditures, you should be able to sustain at least some part of the credit that you're claiming.
I would say that's how I interpret the cases, that when the taxpayer has lost for a complete lack of record keeping, I often suspect the court was not convinced that the underlying activity was actually qualified research at all. And once you've gotten over that hurdle of qualified research, the court will usually allow something, although your lack of records may hurt the amount that will be allowed. I will now turn to some common approaches to allocate wages. However, one thing I would like to focus on, because it often seems to be overlooked, is making sure that your company does not already have some non-tax system in place that you might be able to use, at least in part, to allocate the costs. The reason I suspect that this may actually be there more often than it's used is when I get into defending these cases, and I end up often looking at the initial project plans for a research project, there are often indications in there of estimates for the amount of resources, including engineering time and the like, that are expected to be used. Given the fact that these plans talk about that, I suspect that the engineering group is doing something to check whether or not those estimates are in fact right, but these rarely seem to be used by the tax department. This could well be the result that the engineering resources may not be a full, robust list of what's needed for the tax credit, and therefore would not by itself give you all of the credit you're entitled to. Nonetheless, I think it's advisable to discuss with your R&D management the extent to which they do attempt to track these costs, because even if they're not fully robust to enable you to get all the credit you're entitled to, they can be a valuable backstop to the other methods today that we're talking about. Now, in my experience, I would say there's generally two types of approaches that companies take in working to establish the allocable wages to qualified expenses. First, and I would say the most common, is an after-the-fact approach that relies on some type of interview or survey system where after the close of the tax year, the tax department will reach out to R&D employees, typically the managers, and ask them to do an allocation of the time of the various people under them to qualified or non-qualified activities. Second, there can be contemporaneous systems that are out there where the employee's time to particular projects or particular research activities are collected on a daily or weekly basis and used subsequently for the tax credit claim. As I indicated, the employee survey method appears to be by far the most common method, and it relies on an after-the-fact allocation of time to specific activities. As a result, one thing I've seen is a fairly frequent pushback by the IRS agents auditing a claim, questioning whether or not these types of surveys should be given any reliability since they were not a contemporaneous document. Mike, how would you suggest taxpayers respond to such a challenge?
Sure. Well, fortunately, the use of employee surveys to estimate wages for purposes of the research credit was accepted by the tax court in a recent opinion in the case of Suder v. Commissioner. In that case, the taxpayer's senior vice president of R&D was the officer responsible for making wage allocations for each of the company's research and development employees who were performing qualified research during the year. This officer had initially participated in a research credit study that was done by, that was led by a third-party advisor. And during the years at issue, which were after that initial study, the officer had applied his understanding of the research credit requirements that he learned in that earlier study to then make wage allocations for each of the R&D personnel based on how much qualified research they were doing. And the court accepted this approach, which is very helpful for taxpayers in this who use a similar method, of course. And I would add that this case is actually very, very helpful for taxpayers generally in the research credit area. The opinion provides a very thorough analysis of the taxpayer's product development process and systematically goes through and applies the facts of the case to the four-part test for Section 41. So it's very helpful to sort of learn how the court thinks about these issues and applies the research process to the credit requirements. We would add, though, that the unique facts of the case do render its holding somewhat limited. First, it is a small company. The taxpayer had 125 total employees, about 40 engineers. So clearly, that the company is smaller than, probably most companies that have large research and development activities. Secondly, we would note that, the study was conducted by one person, again, reflecting the small size of the taxpayer. And this one person, because he was overseeing the entire R&D department, had intimate knowledge of each person's research activities and the role that they played in that group. And if you read the opinion, you'll get a sense of how extensive the case actually was, despite the size of the company. There was 3,500 pages of testimony in the case and over 170,000 pages of exhibits. And I think the VP of R&D spent 4 days on the witness stand. So, despite the effort that the company went through to use the survey method fairly effectively, obviously defending their claim in court required a fairly extensive trial. And we would also add, lastly, that while the taxpayer did win on the issue of whether their expenditures were in fact qualified research for purposes of a credit, the taxpayer did lose on the issue of the reasonableness of the amount of the CEO's wages, and that ended up being a substantial portion of the qualified research expenditures that they claim for purposes of the credit. So those factors are something to keep in mind as you're reviewing that opinion.
I mean, the loss is one that I think most large companies will not have. I think the court essentially was questioning whether the chief executive's salary was really representative of the work he was doing or just his founding of the company and his ownership in it. So, I mean, while for Suder itself it was not a great victory, a lot of the principles are very useful. In turning to how you would implement a survey-type system, typically the company starts with an initial look at the various cost centers or departments to determine which ones would have the likelihood of research activities in, so that they don't send these surveys to, the marketing group or, groups that obviously are not likely to have research in them. Then once they've targeted them, they'll go try to make contact with the appropriate head of either an individual cost center, or sometimes one manager might fill out the respond on the part of several cost centers. The contact with the managers can be done either in person or by sending, a survey asking them to fill out. Both of those seem to be fairly common practices. I would obviously urge that the closer you can do it to the end of the year, the better, since it makes it more likely the information will be fresh in the people's minds. This may, though, conflict with other, company demands at year-end close that may make that difficult to do. But, ideally, it helps to be able to say this was done as close to the taxable year as possible. The main purpose of these surveys is to get the allocation of time for individual employees. Typically, you'll see the survey will list every person in a cost center or department and then ask for an allocation of their time between qualified and non-qualified activities. I think the point that Mike made about the Suder case, there it was important that they were able to show that the VP actually knew what these people did. And I think that's often the biggest hurdle in substantiating a survey method. I would urge that you consider having some type of memo about, how closely the manager worked with the department, his familiarity with it, and keep those, in a file. The reason I would say that, you're likely not to see the audit till 3 years or so after they were initially done. I found in a lot of companies there seems to be a fairly high degree of turnover among the managers, and therefore it's quite possible that you won't have the manager available when you're actually being forced to defend the allocation either to the agent or appeals officer, or in the worst case, if you had to end up in the court situation. Now, you would probably, the primary reason you're doing the surveys is to get the time allocation. However, I would say in many cases, people also leverage the study to gain other information, that they'll be at the same time obtaining information about what the activities of the cost center were. It's a chance to find out whether there are any documents that can be used. So you can definitely try to get, since there's already taking up the time of the manager to answer these things, getting additional information like that can be very useful. Obviously, you have to balance how much you can impose upon the engineers and so on, but this does seem like an opportunity for you to try to gain other information that will be helpful in ultimately defending your study. Typically, there will need to be some type of training that you'll want to do for the managers, either by sending them a description of what's qualified and non-qualified, or meeting with them. Since they may not immediately know that certain activities are ineligible for the research credit, such as if the worker left the country for a period of time to help at a foreign location. However, I will say, and the IRS frequently pushes back on the degree of training that the agents have. So, I think it's good to, definitely give the training. You want to make sure that the training materials you use will reflect a balanced approach if they're ever asked for on audit. You want to have the materials acknowledge that there are certain non-qualified activities that are out there, so that the agents can't come back and say, well, you only gave them a choice of qualified activities. However, I would say that it's not overwhelmingly difficult to have the adequate training. I mean, again, going back to the Suder case, the VP that did it learned everything he did simply by observing a prior study, and it's not like he had years of training in the tax area. I think overall it's more important that you have people that actually know what the various employees did, rather than focusing on a great deal of training about the tax law. I mean, I'd be more concerned if you have, one manager who's giving, over 100 allocations, just because it seems to me questionable how well at the end of the year one manager is going to actually know the degree of time they spent on qualified activities. I will say I tend to see in the surveys two variations of how they are filled out. Some of them have very individualized allocations. They'll give one person 35%, another 75%, another 60%, and so on. Other managers tend to use what I would think of as sort of typical buckets, 0, 25, 50, 75, 100. That has a, obviously it reflects less precision. However, I can certainly see some advantages to what I think of as the bucket approach, in that, it's more reasonable for me to believe that somebody remembered that his employee was, 75%. He did some non-qualified things, but pretty much was there full-time, and somebody else did 50. If I had that person on the stand, I think he could come across as convincing, whereas if I actually had to put somebody on the stand with, a department of 40 people and he had, 25 different ratings, I can see him being tripped up on the stand by looking at, the inconsistencies between his various allocations. However, I will say I've had at least one appeals officer that was very impressed by a large degree of variation, and for that appeals officer, that was a very compelling approach. Mike, could you talk about the sort of the contemporaneous types of systems that are out there?
Sure. So, of course, the other common way to estimate research wages is with a time recording system where an employee's time spent performing certain activities is recorded throughout the year. And unlike surveys, as Bill says, these are contemporaneous records, and these are often prepared for financial accounting purposes as well as for tax purposes. Because time recording systems are typically widespread systems that are implemented throughout the company, most employees would have to record their time for various reasons. It has a widespread impact on the company, so it's unlikely that the tax department will be able to impose such a system on the company as a whole if one doesn't already exist. But we would say that the tax department could still make certain modifications to an existing system that can capture tax-specific information, and some of that information could be useful for the research credit. What types of research activities are you doing? What kind of projects are you working on? That sort of information could obviously be helpful once you're down the road when you're calculating your credit or defending your credit in audit or before appeals. And we would also add, lastly, that having a non-tax purpose, such as financial accounting purposes, for such a time recording system only enhances the reliability of the data. So, obviously, if you have some type of a system that's designed specifically to capture information for purposes of the research credit, examiners might look on that with more skepticism, as opposed to a system that you use in your accounting system more generally. There's a lot of different ways that you could have a time recording system, and there's three common methods shown on this slide here. One is a project level time record. These systems, for these systems, taxpayers might simply record the amount of time that research and development employees are spending on a particular project. Another type of common system we've seen is a system in which the amount of time spent performing a specific type of research activity might be recorded, and not necessarily recording the amount of time you're spending on a project per se. And lastly, there's more detailed systems which capture both the type of project or business component that you're working on, as well as the specific type of activity that an employee is doing. So I'll go over into more detail what a project level time record system might look like. Obviously, these systems will track the amount of time an employee is spending on a particular research project. And this approach has the benefit of simplicity. Of course, research engineers and development engineers might be spending less time on such a system if they're only asked to record, the amount of time they're spending on a broader project. And given that, there's also potentially less opportunity for inconsistent or inaccurate recording because it's simplified. There's no need to determine how much of your time is spent on this type of activity versus other types of activity. The differences between types of activities can sometimes be hard to determine. So this approach certainly has that benefit. Obviously, though, if a system only captures a particular project, the particular activity of each employee is not captured. Therefore, we've seen exam agents argue that these types of records sort of fail to adequately substantiate the amount of time allocated to qualified research because they're unable to link projects with specific activity. So continuing with project-level systems, even if your system only records time spent on a particular project, this information is still very useful. One example we can point to is your engineers might be focused on a particular project throughout the year that's clearly qualified research. So even if information on the specific activities that the person is doing on a daily basis is missing, it's clear, given the type of project he's working on, the type of engineer that he is or she is, his or her wages should be qualifying research. And you can maximize the value of project-level data sometimes by collecting project plans or other types of documentation from projects that further illustrate the company's research and development activities. And one way you can improve upon the persuasiveness of this documentation is by educating their exam team on your company's research and development process, the various phases of that process, and how each part of the organization fits into the product development process. With that education, your IRS agent might have a better understanding of how the various activities being performed by your R&D department fit into the requirements of the credit. And as we said, there's also systems in which taxpayers might only capture activity-level time records. And these systems present sort of the opposite challenge. That is, you're now missing information about a particular project or business component that's being developed by the R&D department. And so here, the IRS might argue that it's impossible for them to have a complete understanding of the employee's research activities if they're unable to, again, match the task with a particular project. One thing we will add here is that project-level information might be important if employees in your R&D department are involved with multiple different types of projects at the same time and potentially at various stages of that project. And without having any visibility into the specific activities that they're performing, that's going to leave your system susceptible to some challenges by your exam team. If you do have an activity-level system in your company, it might be possible to modify that system to capture project-level information. Of course, if you're already asking your employees to record time spent on specific activities, adding a project field or a field to capture what type of business component they're working on should be a manageable ask. And that could be very helpful down the road if you have to defend the wages you're allocating to your research credit to your exam team. One thing we will add here, though, is that before you go spending a significant amount of time trying to get project-level information, consider if it's actually meaningful to you, to your company. For example, if you have engineers devoting a substantial amount of time to the same task over and over again, so if you have software engineers who are focused on alpha and beta testing, determining which projects he or she is working on at a given time is not going to change the fact that his or her wages are going to be qualified, right? I mean, he or she is devoting all of their time on beta testing. That's a qualified activity. At the same time, if your company is devoting all of its R&D time to a small number of projects throughout the year, trying to figure out how much time an employee is spent on which project is likely going to be not that meaningful if you can prove that the employee's activities are qualified research.
I mean, if you have something like a new aircraft being developed by Boeing, because probably all the employees are spending all of their time on that new aircraft, and it becomes much easier after the fact to prove what they were working on.
Now, there's also more detailed time record systems in which you're capturing not only the project someone's working on, but also the number of hours that they're spending on a particular type of research activity, which is, whether it be design modeling or software testing or other types of testing, building prototypes, for example. A system such as this is obviously helpful because it captures as much information as you could possibly capture probably in a system like that. But even if you do have a detailed time record system, it's not necessarily bulletproof. So the IRS has various ways they might challenge that. For example, if your system doesn't allow employees to indicate non-qualified activity as well as qualified activity, that's a possible area in which exam teams might challenge the reliability of your system.
Yeah, it is surprising that even with the contemporaneous systems, I have seen IRS agents want to challenge it. I mean, I've even seen one go so far as to say, well, how do I know the employee filling out the time card was doing so reliably? I mean, that's sort of the height of ridiculousness that you'd have some employee monitoring each employee while they're filling out their timesheet. But I have actually seen that argument raised on audit, although it was pretty quickly dropped when it got to appeals. But they do, as Mike said, focus on, if your recording system doesn't seem to readily give away of recording non-qualified time, that's something that a agent is likely to focus in on. So you want to be trying to shore up that by having some potential for non-qualified time being picked up. Agents also have liked to do some kind of sampling of the time record system and want to follow up with interviews or other ways of trying to verify whether they're right. I would tend to urge you to push back against that as much as possible, emphasizing to the agent that the value of such a system is that the records were contemporaneous. It's much more reliable what the employee wrote down on the day he did it than what the employee remembers 3 years after the fact by the time the audit is coming up. I mean, it's particularly unrealistic to expect the employee to remember what he did on a particular day. And I have seen, in interviews where the agent is, whether intentionally or unintentionally, tripping up employees on something like that, as to, the employee really just doesn't remember what he did on July 14th, 3 years ago. And that would be particularly true if the employee tended to do work on multiple projects over periods of time. I've also seen confusion with the agent, asking an employee why he was only working 400 hours a year, which actually was really proof the system was working correctly because the employee spent most of his time working on non-qualified activity, and the system correctly picked that up. However, it was awkward during the interview because the employee at the time of the interview didn't know how the system had been set up. And so he was kind of fumbling, when I read the transcript. I wasn't involved in the original interview. But, so the employee's going, well, I know I worked more than 400 hours that year. I don't understand why I keep track of my time. So it's just kind of the examples of the problems you can get into when the agent goes down that route. Other problems I see with sampling of them is, the agents have gone down to get, in some levels, the hour, 1 hour entry on a particular day, there's no way an employee is going to be able to verify that after the fact, or that any kind of testing about it is. I think you really just have to make your argument that, look, the system is the system. We had it in place. It's a valid system. We really can't go back now and try to do interviews or other ways of second-guessing what was done initially. For all of the timekeeping systems, I would suggest that you step back and think about where the potential weaknesses or challenges might be. And certain areas I would suggest thinking about are the high-ranking employees. That often becomes a question of whether these were supervisors or whether they directly did research. So you may want to ask those employees to provide some kind of memorandum or other documentation showing that they were actually involved in research despite being perhaps a VP or some similarly high-level area. Another area where I've seen more explanation being necessary is where you have a cost center that sort of supervises other cost centers. The IRS will typically tend to kick that out immediately, saying they're supervisors. But if you dig into it, I've often found that these are really, in my mind, managing the research. I mean, if you think about it, if you're just one person doing research, you know what tests you have to run. If you're doing something like my example a few minutes ago about developing a new aircraft, there could be literally thousands of tests. And no one person is going to know all of them. So these types of managers are often looking at a whole set of tests or subset of the tests and making sure everything is actually in line. I would strenuously argue those people are doing research. They're not managing the other people. They're managing the data that comes out of it. Obviously, you probably want to think about, the high dollar cost centers. If there's some that are just much, much larger, that they're going to be critical to defending your claim, you might want to think about what can be done to bolster that when the day comes it's challenged. Similarly, if you have cost centers that are doing substantially non-qualified activity, additional evidence that those people were involved in research might be worth gathering. With that, we'll turn to the accounting for supplies and contract research. Mike, can you tell us a bit about some supply questions?
Sure. So most of what we've discussed up until this point deals with allocation of wages, of course, but in-house research expenses includes the costs for supplies that are used in the conduct of qualified research as well. So supplies typically are allocated proportionally in accordance with the qualified research activities that are taking place. So in other words, when you have cost centers with a higher percentage of qualified research activity, those cost centers will receive a correspondingly higher percentage of the research supply costs. And one recommendation we could give is that you may want to consider asking about the use of materials and other supplies during interviews with cost center managers to see if, if this allocation of supply costs based on the amount of research that's being done is appropriate for your company. But in large part, the percentage of supply costs that are allocated and how they're allocated is usually accepted. The issue most often is, what costs are being charged to research supplies. One common problem that we've seen in the past is that if employees don't have an account to put miscellaneous one-off costs, they may sometimes throw that into a supply account. And that can cause problems later on when you're trying to defend the nature of supplies that are being charged to research, research expenditures, because many times one of those miscellaneous one-off costs are not obviously supplies used in the conduct of qualified research. So one recommendation we would have is that maybe having a miscellaneous account where employees in R&D departments can charge one-off expenses without having this problem come up is a good way to handle that potential issue.
I mean, I will say that in my experience, if you get an agent that wants to actually dig into what the elements of your supply accounts are, I'd say there's a high likelihood that expenses that are non-qualified will be in there. For the reason Mike just said, that the expenses are kind of legitimate expenses for the department, but they just aren't supply expenses. I mean, I've seen, where do you charge the, one company charged, the cost centers for meals that they ordered in for, meetings of their group. And so those ended up in the supply calculation. Fully appropriate for the manager of the cost center to put it there, but not qualified expenses. I mean, I've seen, the plant lady bill for the person that takes care of the plants. I've seen trophies that were given for the completion of, a successful project where they went out and made, 30 trophies, congratulations for blank. I've seen the cell phone accounts in there. So, I mean, it's a fairly typical that there'll be, if you really kick the tires on them, non-qualified items in. In most instances, I would say, it's just sort of a risk that you have to live with. I wouldn't recommend going out and auditing all of your accounts. In most cases, the dollars that will be found there are not that material, but you probably should be aware that it's likely that those would come up if you don't have some other, safety valve account where the employee can charge the activity. There are, we're running a little late, so I'm going to move on to the contract research credit one. There, I would say you're entitled to deduct the expenses that are paid or incurred by the taxpayer to any person other than an employee of the taxpayer for research. From a cost allocation purpose, this is usually less of a challenge because you're actually paying a third party for the expenses, and therefore the records will be fairly clear on the how much was paid. However, there still are issues that come up in monitoring the expense accounts on these. I would say there's typically two types of contract research out there. You can have sort of the outsourcing of the entire research project. You ask some independent company to help you develop X component, and the contract is entirely for that activity. So therefore, you don't have to worry about the details of what was done by the third party. You can just deduct, use the entire charge for it, subject to the fact for contract research you only get 65% of the amount. So in effect, these types of overhead costs, non-qualified activities that might occur at the contractor are taken out of the system by the 65% rule. The other area that I see is, where you're hiring contract labor rather than contracting out for the entire project. I mean, this often is the case for SAP implementations or other software projects where additional people are brought in for a particular project on a contract basis and then will be let go once the project is completed. in that situation, it's much more important to document what those people were actually doing with their time, because there's a range of activities that they could have been doing. I mean, in the software implementation area, I often see the problem that technical writers to describe a new software release are often hired on a contract basis, and that would not fall within the research activity. So when you're sort of hiring individual labor, it becomes more important to track which activity that they were doing on. I mean, here, even if the person's doing 100% qualified work, you're still going to have to apply that 65% rule, which might be unfair, but you're certainly going to have to kick out the people like the technical writers on it. Another thing that you want to watch with contract research these days is where the research is being performed. To stick with the software development area, I see more and more that portions of this outsourcing are being done in India, and that is not going to be qualified time. So you want some way of being able to identify which portions of the research are not eligible for the credit. Mike, do you have any other thoughts on documenting the research credit?
Sure. I'll add a quick note here about documenting contract research. So if your company routinely has contract research, one thing to keep in mind is that your documentation should make clear who owns the rights to the finished product and who assumes the risk in conducting that research. And the regulations under Section 41 have a three-part test that your documentation should meet. First is that the documentation or the agreement must be entered into prior to the performance of the research. It should provide that the research is being performed on behalf of the taxpayer, and that the agreement should require the taxpayer to bear the expenses even if the research is not successful. And that the regulations go on to add that if the payment is contingent on the success of that research, then the payment is actually for the product itself rather than the performance of the research. And so that goes back to the assumption of risk issue.
Okay. To sort of sum up what we've been covering today, I think some of the highlights to take away are to remember that employee surveys are a defensible method of cost allocation to use. While it's not bulletproof, the Suder case, I think, gives you a strong response to any agents that try to challenge it. I would emphasize, though, that you want to think about the employees who are completing the survey having an understanding of the research credit, particularly in the sense of what activities typically are not qualified, and have a true personal knowledge of the activities of the people that are doing the research. And I would suggest that you document that in some way. If you have a contemporaneous timekeeping system in your company, those records can be highly advantageous. However, I would caution that even with a system that's contemporaneous, done for non-tax reasons, you still may find the agents challenging it, and you should push back on that to whatever extent is possible. But don't be utterly shocked if you still have a problem with the IRS. Where you have a system in place, think about the type of things Mike suggested. That if you only have an activity system, can you add a description of what the project is? I would think that may be a relatively simple fix that you can put into the system without disrupting your company's operations. And remember that there's other documentation of the research that can support the activity. I mean, if you have a project plan that says certain cost centers are going to be working on it extensively. That gives secondary backup for a survey that shows most of the people in that cost center spending time on the project. Supplies are an often overlooked area, but they can result in some substantial adjustments. I mean, that one I mentioned about meals, when you added it up, it was several $1 million of meals over the course of all the departments. So, that is a item there. I would, think about whether how you're allocating it. As Mike says, that's usually not challenged. But often what I see is in a cost center, the overall percentage goes down because you have some supervisory people in that cost center whose wages are reducing the overall amount. But I would think in many instances those people aren't using the same type of materials that are actually going into the research. So you still may have a very high percentage of the people being qualified research. The supply should still be usable. For contract research, the costs are usually pretty clear, but you still have some documentation issues where I think you want to think about documenting what the contractors are doing, where they're doing it, and who owns the rights to the research. We're fairly close to the end. I think I can take one question. I had a question about to what extent are employee interviews helpful? And that's something I would say I see a lot of IRS agents that are often very big on getting those employee reviews. In my experience, however, they tend not to really be that helpful. Typically, a performance review will focus on one or two activities that were particularly important and don't necessarily give you a view of what happened over the course of the year. On the other hand, I will say from the IRS perspective, if you look at enough employee interviews, you'll probably be able to make some adjustments. I mean, I typically find problems like the employee review will say, we really appreciate he went to India for 6 months to help get up the new line, but we've claimed 100% of his costs in the U.S. So the interviews from the employee performance reviews from the IRS perspective may enable them to knock out some amount, although I typically don't find it that large. With that, I think we need to end it. Certainly feel free to email me or Mike if there were some questions that you didn't get time to give us. We appreciate your taking the time today. Thank you very much.